This is not a growth story anymore. This is not even a turnaround story. This is a everything must go right trade. CGN Power operates in one of the best long-term industries: clean energy, nuclear expansion, rising electricity demand. But the stock is already pricing all of that in. And here's the problem. The business is getting harder, not easier. The business looks stable on the surface, but underneath, it's weakening. Revenue is flat to slightly down in recent periods, while profit is declining. In Q1 2026, net income fell 9% year over year, driven by lower power output, weaker tariffs, and higher costs. Margins are compressing. Operating cash flow is under pressure because electricity prices are falling while costs are rising. At the same time, capital spending is going up. That combination is dangerous because it means the company is investing more while earning less per unit. What changed is simple. This used to be a stable, utility-like business. Now it's becoming a capital-heavy, price-pressured operator. The stock is expensive, not slightly, materially. The current price is around 3.44 HKD, while fair value is estimated at 1.30 HKD. That's a 2.65 times premium. So what needs to happen for this price to make sense? You need successful capacity expansion, stable or improving tariffs, controlled costs, no balance sheet stress. That's a perfect execution scenario. But the current business trend is the opposite. Tariffs are falling, costs are rising, and leverage is increasing. You're not buying what the company is today. You're buying what it might become, with zero margin for error. The strategy is clear: massive expansion. CGN plans to grow capacity from approximately 32 gigawatts to over 46 gigawatts by 2030. That sounds bullish, but it comes with a cost. This is one of the most capital-intensive industries in the world, and the company is already highly leveraged, with net gearing hitting approximately 180%. So, the strategy is logical from a national and industry perspective. But from an investor perspective, it's a capital drain before it becomes a return generator. CGN is a leader in nuclear power in China. That's its strength. Scale, experience, and government backing matter here. But it has two structural disadvantages. First, it has no real moat. Even Morningstar explicitly states the company lacks a durable competitive advantage. Second, it's competing in a changing energy mix. Companies like China Resources Power, China Datang Xinyi Energy are exposed to renewables, which are growing faster and often getting priority in grid dispatch. So, while nuclear is stable, it's not the highest growth or highest priority segment anymore. The risks here are very concrete. Tariffs are declining because more electricity is traded on the market, and market prices are lower. Renewables are increasing, which reduces utilization of nuclear plants. Costs are rising, especially fuel like uranium. And the biggest one, the company is heavily leveraged while still investing aggressively. If cash flow doesn't improve, the entire expansion story becomes a balance sheet problem. There is a path where this works. If capacity expansion delivers as planned, tariffs stabilize through regulatory support, demand rises significantly, for example from AI-driven electricity usage, then earnings could scale over time. But here's the catch. Most of that upside is long-term, post-2030. The market is pricing it in today. This is not a clean growth stock. This is not a safe utility. This is an execution-dependent, capital-heavy bet with no margin for error. The business is solid, the industry is strong, but the stock is priced for perfection. In a business that is getting more complicated, not less. I'll break down the next one soon. Subscribe if you want to stay ahead.